All right, let's get right into it. Welcome to This Explainer. Today, we're taking on a genuinely fascinating subject, and our mission is pretty simple. We are going to decode Kenyan tax law into a clear, highly strategic playbook. We're taking what usually feels like this completely intimidating maze of rules and regulations, and we're going to transform it into a structured, easy-to-digest guide that gives you absolute clarity on the rules of the game. Okay, let's dive into this. When you hear the word tax, what's the very first thing that pops into your head? It's probably a mountain of calculators, endless spreadsheets, and accountants just furiously crunching numbers, right? Well, actually, scratch that. Let's shatter that misconception right out of the gate. Tax is not just math. Tax is entirely about legal interpretation. Sure, the accountants are the ones applying the numbers, but every single cent you pay is strictly dictated by how the law is interpreted. So, here is our cognitive roadmap for today. First, we'll cover the foundations of tax. Then, the core principles of taxation. Third, we'll navigate income taxes. And finally, resolving tax disputes.
Starting with Section 1, the foundations of tax. This is basically your ultimate rulebook.
You know, it's absolutely vital to understand that every single tax, every deduction, and every filing timeline exists strictly within a legal statute. Literally nothing is arbitrary. And this brings us to the bedrock of the whole system, Article 210 of the Constitution of Kenya. It states, and I quote, "No tax or licensing fee may be imposed, waived, or varied except as provided by legislation." This constitutional anchor is incredibly powerful. It's the ultimate safeguard that prevents arbitrary taxation by any public official, guaranteeing absolute certainty for you, the taxpayer. Basically, if a tax isn't explicitly written in the law, they simply cannot charge you for it.
And this brilliantly illustrates how the framework is actually built. These are the heavy hitter statutes, and they control completely different pieces of the board. You've got the Income Tax Act, which obviously covers income derived from Kenya. Then there's the VAT Act, which is super interesting because it operates by exclusion. That means that applies to absolutely all goods and services unless they are explicitly excluded or zero rated by the law. Then we have the Excise Duty Act. This started as a classic sin tax on things like alcohol and tobacco, but it's now morphed into a much broader general tax. And finally, the Tax Procedures Act, which is essentially the administrative guide dictating exactly how taxpayers and the Kenya Revenue Authority, the KRA, interact. Moving right along to Section 2, Core Principles of Taxation, going all the way back to Adam Smith's 4 canons. To really grasp the why behind these laws, we have to look back to Adam Smith's famous work, The Wealth of Nations. Now, the primary canon we're focusing on today is equity. The concept of equity is pretty straightforward. It means taxpayers should contribute in proportion to their ability to pay. Put simply, those with more financial resources should bear more of the tax burden. It's all about baking fairness directly into the structure of the law. And we can see this equity in action through Kenya's PAE, or pay-as-you-earn, tax bands. A low-income earner making, say, 20,000 shillings falls right into the 0% tax bracket. They are completely exempt. But contrast that with someone earning over 800,000 shillings a month. They get hit with the maximum rate of 35%. It proves the law is deliberately designed to scale right alongside your income. Let's jump into Section 3, Navigating Income Taxes. Time to look at the actual mechanics of the game. Now, what's really interesting about this slide is how it clears up a massive, and I mean massive, misconception. So many people think withholding tax is this completely separate extra tax. It's not. It's simply an advance collection method. Let's say a law firm bills a client 100,000 shillings for legal fees. The client might deduct in advance 5% and send that straight to the KRA. The law firm then gets 95,000 shillings in cash, plus a certificate proving that 5,000 was already paid toward their total tax bill for the year. See? It's just an advance payment. And speaking of that total tax bill, I want you to mentally stamp this number into your mind right now, 30%. That is the standard corporate income tax rate in Kenya. Whether you're a locally incorporated company or just a registered branch of a foreign company operating locally, 30% is the baseline cut of your taxable profit that the government is going to collect. But wait, how do you actually calculate that taxable profit? Well, the law is incredibly strict here. Any deductible expenses you use to lower your taxable income must be, quote, wholly and exclusively incurred in the generation of that specific income. So taking a client out for a round of golf to build business and drive up your legal fees? Yep, perfectly deductible business expense. But taking your family on a luxury vacation to South Africa? Absolutely not. No way.
The expense literally has to generate the income.
And what about when you sell a major asset like land? That triggers capital gains tax, or CGT, which is currently sitting at 15%. But keep in mind, this rate applies strictly to your net gain. So if you bought a plot of land for 5 million shillings 10 years ago and sell it today for 10 million, your taxable gain is 5 million. You pay 15% on that 5 million profit, which comes out to exactly 750,000 shillings. It's a precise mathematical formula, which, by the way, is exactly why keeping meticulous, bulletproof records of your original purchase costs is absolutely crucial.
Finally, Section 4, Resolving Tax Disputes. Welcome to the high stakes and ticking clocks.
This right here is the climax of our explainer, because whenever money is on the line, disagreements are going to happen, and the KRA steps in as the referee under the Tax Procedures Act. Now, Kenya runs primarily on a self-assessment system. You crunch the numbers and declare your own liability by June 30th. But the KRA has serious audit powers. They can look back through your records for up to 5 whole years. And if they decide your self-assessment was wrong, they'll hit you with an amended assessment, which is basically a formal demand for more money based on their interpretation of your books.
So the crucial point is this massive plot twist that catches so many people completely off guard. In normal civil law, whoever makes a claim has to prove it, right? Innocent until proven guilty. In tax law, that is completely flipped. The KRA's tax assessment is legally presumed to be correct by default. If you disagree with their demand, the burden of proof rests 100% on you to prove the KRA wrong. And if you're going to prove them wrong, you have to navigate an incredibly strict, unforgiving procedural maze. Let's break this timeline down slowly. On day 1, the KRA issues the amended assessment. From that exact date, you have precisely 30 working days to file a valid notice of objection, fully loaded with your grounds and all supporting documents. If you miss this 30-day window, game over. You automatically concede to the tax demand by operation of law. If you do manage to file on time, the KRA then has 60 calendar days to review it and issue their official objection decision. But let's say the KRA rejects your objection and demands the money anyway. Now you have to climb the judicial ladder. You have just 30 working days to escalate the dispute by filing a notice of appeal to the Tax Appeals Tribunal, or the TAT. From there, either side can appeal to the High Court, but get this, only on matters of law, not the facts of the case. After that, it can move up to the Court of Appeal, and in super rare cases involving constitutional issues, it can go all the way up to the Supreme Court. You really don't want to ignore a tax demand or miss these deadlines, because the KRA's enforcement powers are severely intense. They can issue agency notices straight to your bank, legally forcing the bank to drain your account and send the cash to the KRA. They can issue departure prohibition orders. Imagine showing up at the airport for a trip and finding out you are literally blocked from leaving the country. They can slap caveats on your physical property. And if they determine there's tax fraud involved, they can hit you with a mind-boggling 200% penalty. As we've seen today, tax is definitely not just math. It is a rigorous legal framework where the rules dictate absolutely everything, from exactly how much you pay to how fast you have to defend yourself. Which leaves us with this final provocative thought to chew on. If the KRA is presumed right by default and that 30-day clock starts ticking the very second they knock on your door, how ironclad are your records today? Thank you so much for joining me on this explainer. I really hope this playbook helps you navigate the incredibly high stakes of tax compliance with absolute confidence.